Today on the show, we're going to do a January mortgage update. It appears that a lot of questions in our Facebook group are property and mortgage questions, which I find annoying because I like talking about other stuff. But all that to say, Rach, a lot of people have mortgages on this island in the South Pacific. And I reckon it's important that we do a bit of a January update. And this is what we're going to do today. So we are recording this at the end of January. It's going up on the 27th of January, 2026. Why is January so important to review a mortgage?
Yeah, I think a lot of people do goal setting in January, and I think a lot of people just do a reset and have a look at their, I guess, whether it's their home loan or whether it's their finances overall. But I think what a lot of people do is look at what they want to achieve in the year, and a lot of the time that does get impacted by your finances. So it is good to look at them together.
So if we talk about the importance of January reviews on someone's mortgage, there's nothing in the background that's mandated that in January every year, every bank releases a new policy or the RBA or APRA do something in January. It's just a good time to set up the year because a lot of us aren't at work yet and are in chill Vegas.
That's right. And traditionally, it's a really busy month for us because people are off work, they're at home, and they're looking at their goals. So they would be reviewing their mortgages at that time.
Yeah, awesome. So if we look at current trends, as at right now, last 3 months, what are you seeing in your business?
Yeah, I think a lot of people are looking at their finances overall. And I think a lot of people move in January because they know what they want to achieve for the year. So whether that's buying another property or whether it's selling a property, whether they're upsizing their home or whether they're tidying up their finances. So a lot of people do maybe have a blowout at the end of the year in some way and they've got some things to tidy up in January. So I think when people come to us in January, it's more of a, this is my goal for the year, this is what I want to achieve, or it's a, this is what I didn't feel went well last year and let's clean it up.
So the behavioural stuff aside, have you seen over the last couple of months and right now, at the end of January, any particular, and let us know if we'll cover it later on, but any other trends from an industry perspective or in bank land or interest rates?
So I guess, we've got the RBA meeting, well, by the time this goes up, it'll be next week.
Yeah.
And I think investors are really thick and fast in the market at the moment. So if I looked at our percentage of people that bought in January, it's definitely highly skewed to investors.
Right.
And I think the reason that may be is because investors are wrongly or rightly predicting there could be a rate rise. And so a lot of them are wanting to get in before that happens because rate rises can impact serviceability. So that's one thing that I think might be a trend. And another trend is just, I guess that people at the end of last year, we had, some changes where people could borrow again, especially investors. And I think they wanted to take advantage of that. And a lot of them took that long, it's a decision that takes some time. So a lot of people who made the decision maybe late last year to buy are buying now.
But it speaks to, you mentioned, every month the RBA meet and set rates and whatnot. I think it's really important that, sure, if you decided, we do want to buy an investment property or we do want to upgrade the home, sure, let's get moving. Hopefully we can get in before the rates increase. But the flip side of that is forget a whole heap of external variables. Focus on what you want to do and work towards it because you can't control the outcome, whether the rates go up twice, down once. Because we start doing our property investing based on RBA meetings and external factors, I don't think that leads anywhere good.
No, and I don't think anyone would set their strategy based on that. But I think if, let's say you had a pre-approval to buy an investment property late last year, and let's say you predicted a rate rise in February, that could mean that your approval doesn't stand because when rates go up, everything. So if you're an investor with 5 properties, that goes across your whole portfolio, that rate rise, and you might be able to borrow a lot less.
Yeah, and I think,
even though you would not buy because of a rate rise.
Yeah, that's a good point.
You just ride the wave.
Yeah, I didn't think of that. It was more don't drop everything and abandon other short-term lifestyle goals or other short-term actual financial goals to bend over backwards to try and borrow the extra $100,000 this month.
That is right.
Yeah. So have a plan.
Have a plan.
Get onto it.
A lot of people last year too had, I guess, a lot of people were quite fortuitous in what they bought last year, as in it went up in value. So when you have, you might have bought a property in January last year and come January this year, it may have gone up in value, and that gives people a lot more choices in what they do.
And we will talk about equity.
Yes.
But until then, this episode is brought to you by Sphere Home Loans. Rach is Director of Sphere Home Loans. Assume the whole episode's an ad, everyone. I don't want to talk about Sphere Home Loans. But I will say, if you are listening to this and you are in Auckland, I'm coming to do a live recording in Auckland on Wednesday night, the 18th of February. I think tickets are under or around $40 NZ. I think whatever that is, it's not expensive. I'll feed you, I'll drink you, and we'll have some fun. Probably keep it to under 40 people. As at the time of recording, we have sold some tickets after the first day of releasing tickets. So I'm confident we'll get a small, decent group of people. But yeah, if you are in Auckland or surrounding and you want to come and say hi and have dinner with us and participate in the live show, Wednesday, 18th of February in Auckland. First time I've done a live show in New Zealand.
What an awesome place to have it.
Yeah, it should be good. My name is Glen James, joined by Rachelle Kroon. We're doing a mortgage and property. We'll call it a mortgage and property update, I think. And before we go to the bump, does it feel, because this is the first time you've done a podcast with me, with the shotgun mics and not like the mic in front of your head, do you feel a bit nude?
It does feel weird not having the mic in front of me.
Can't hide behind it. So yeah, give us some grace, everyone, while we try and get these mics all sorted. If you are watching on YouTube, you'll see that we're really paying a lot of attention to our slides to make the viewing part of this better. And thanks so much for listening. As I said, my name is Glen James, and this is Money, Money, Money. Before we get into it, this show is general advice only, and I've got a license to provide that advice. Full details can be found in the show notes. I'm a former financial advisor. Now I do the Money, Money, Money podcast. If you're a regular here, we call it M3, and we do a podcast called Retire Right. I've got a book, The Quick Start Guide to Investing, is available wherever good books are sold. There's a link in the show notes if you want to turn up your investing to 11, or if you're just getting started. Let's get into it. Thank you so much for being here today. Rach, we mentioned at the top of the episode equity. Do you want to maybe give us a bit of a 101 about equity?
Yeah, sure. So your equity that you have in a property, so when we're relating to property, it's the difference between the value of your property and I would say minus the mortgage that you have on that property. So let's say you have a property that's worth $1 million today.
I'll get you to draw it for the people watching.
Yeah, sure.
And just explain how equity works, because it's a really important thing to understand.
Yeah, it is. I would say it's one of the most important things when you're talking about property and buying property is to understand equity and maybe even the difference between equity and usable equity. So I'm just going to draw a house here, and let's say this whole house is worth $1 million.
Awesome.
And I'm going to put what usable equity is. So you can't, if you've got a house worth $1 million, you can't go and lend $1 million on it. So we're going to say 80% is the usable equity, and that's
and that 80%, that's the magical number that you won't have to pay lenders mortgage insurance for. And
look, and so that's your usable equity on this property is $800,000. But there's a lot of people at the moment that are borrowing 95% of the value of properties using the 5% guarantee scheme. There's also people who would borrow up to 90% without mortgage insurance in certain industries, but just for simplicity, I'm going to say 80%. So let's say you've got a property worth $1 million and the usable equity is $800,000. And let's say your mortgage here, let's say you've got I'm not terrible at drawing these, $500,000 mortgage. The difference between your mortgage and the usable equity here is $300,000. So you've got $300,000 in usable equity, which is $500 your mortgage, $300 is your usable equity left, and the $200 is the stuff that the bank won't lend on without mortgage insurance or extra fees.
So that 20% the bank quarantine. So if the property market tanks at the time and at that same time you can't pay your mortgage, they know the property market probably hasn't tanked more than 20% and they'll be able to recoup the money from selling the property.
And when we talk about this in lending terms, we use the term LVR, which is loan to value ratio. So in this case, we're saying usable equity is 80%. That would be if you had a mortgage of $800,000 on $1 million property, your LVR is 80%. If you had this same property worth $1 million and you borrowed $950,000, your LVR would be 95%.
So that's the 101 on equity. And on the right-hand side of that laptop, if you just press it with your finger, why is equity so important? And particularly, you touched on at the start with people have bought property and the prices has increased in the last 12 months. Why is this equity so important even within 12 months?
That's right. So when you buy a property, and your LVR at the time you buy is important because banks price for risk. So let's talk about rates for a moment. Let's quarantine it and talk about your mortgage rate. If you buy a property today and you borrow 90% of the value of the property, the bank might give you a rate based on a 90% LVR, but they may have given you a lower rate if you only borrowed 80%. Now, if you bought a year ago and your LVR at the time of purchase was 90%, it very well could be 80% now. So if it's 80% now, it's the time to renegotiate your rate because you've got more equity than when you purchased it.
So, for example, if someone did traditionally went and got a normal home loan, and we'll just, for round numbers, $1 million purchase price, they put $150,000 in.
Yep.
Right? So what we got?
They borrowed 85%.
Yep. If, for example, in the background, the bank or lender would have a thing to say the interest rate based on an 85% lend is 6.2.
Yep.
And then the next line, interest rate on a 80% lend might be 5.8.
Yes.
So what you're saying is over the course of a year or 2 years, the equity can do some heavy lifting. So if the mortgage was re-reviewed, there is more equity, lower LVR, so that fits into the lower interest rate band because there's less risk for the bank because they're lending less.
That's right. So I'll give you an example of one that I looked at this week. So this person had their own home. And I can't remember off the top of my head what this home was worth, but they had a mortgage here. That was their mortgage. And then they bought an investment property here last year. And when they bought that investment property here, and I actually can't remember what it was, but let's say they bought it for $600,000 and let's say they borrowed $420,000, so 80% against this property, and then they put the 20% plus costs against their home. So this is sitting here at 80%.
So the standalone new investment property is 80%?
That's right.
Yep.
Now forget all about this home loan here. This property was worth $600 increased in value quite substantially over the last 12 months. And this LVR isn't 80% anymore because these stand alone.
Yes.
It's now 60%.
Right.
The rate was 5.94 when they got their mortgage a year ago, and they've just renegotiated with the same bank down to 5.59 for interest only investment lending, which is 0.4 less. So they're actually going to be saving $2,800 a year on this mortgage because this property went up in value.
So the investment property, they got the investment property, it was a higher interest rate because the LVR was 80% secured against the home. A year later, the investment property increased in value, and then they could then reassess the investment property because there was more equity in it and get a lower interest rate.
That's right.
Yeah.
That's
and
right.
I'm mansplaining back to myself so I understand.
So even if you put this in a more simplistic way, even if you were, just a first home buyer and you bought, let's say you bought for, you had a 5% deposit and the rate was a certain percentage on that 95%, well, that rate might be a little bit higher than what you could get if it was 85%. So if you've bought a house, it's your first home and it's gone up 10% in value, well, then you should, in essence, be able to get a better rate now than when you're at 95%. Now, that's just talking about rates. Equity can give a whole lot of other things, like the ability to buy another property or take money out for other things or renovate your home. But I think one of the most prevalent right now is the release of guarantees, both the government and parental.
And we'll talk about that later in the episode. Now, if you just press twice, just tap twice. We want to talk now about fixing rates out there in the wild at Sphere Home Loans. Are you doing much fixing? And what type of rates? I don't know if you've got them off the top of your head. Or
So I think...
okay, let's go. I want to do never make broad statements ever, because there's nuance in life. But if you were to say a broad statement, would you tell someone, and I'll put words in your mouth, spit them back out if you want, if your mortgage or your investment property mortgage has a 6 in front of it, and you've had that property for over 12 months, maybe go back to your broker?
Absolutely.
Okay.
If you don't have a 5
and the reason I said,
in front of it, go to your broker and ask for a review.
If it's been more than 12 months, because someone might have got a mortgage yesterday at 6.03, well, the bull probably hasn't moved anything, and that's your rate. But if you've had a property for over 12 months, shouldn't have a 6 generally?
It definitely shouldn't have a 6.
Okay.
However, I would say, you said it's 12 months for a review.
Yeah.
Absolutely. But if you bought a house 4 months ago and you've had a comparable sale in your street that's going to say that your house may sell for more now and you're paying a higher rate, it's still worth a review.
Absolutely.
Because you've got that equity.
But I just, the broad statement is all, and that's why you don't make broad statements.
Yeah.
So based on that.
Coming back to fixing. I would say not a huge amount of people are fixing at the moment, but there are some. And it would be, like, if you're an investor with multiple properties, are you going to fix? Probably not, because you need to keep your portfolio fluid. And when you fix a loan, there's exit fees if you leave, if you pick up and move. So a lot of investors want to stay fluid. But if you look at a first home buyer or somebody who's got a fixed mortgage that they're going to be paying for a period of time, they know their plans, they know what they're doing. They may choose to fix not because they think they're going to beat the banks at their game of picking rates, but because they want the certainty of knowing what they're going to pay every week. So when we sit down and talk to somebody about fixing, it's not about, do you think the rates are going to be, am I going to save money by fixing? Because more often than not, you don't.
So the broad statement is, unless it's 2021,
that was an anomaly.
That's right. And that's why in 2021, you were fixing knowing that money ain't getting cheaper.
No.
And I'll beat the bank here.
Yeah.
But ordinarily, we're only fixing for personal certainty.
If it fit your goals to fix, if you go, well, even if rate, and the question that you tend to ask is, if rates went down, how would you feel about fixing?
Yeah.
And when someone says, even if they went down, I'd really prefer to fix because I want the certainty of what I'm going to pay every week, you're a fixer.
Yeah.
Get it done.
But also, it doesn't have to be all or nothing, does it?
It doesn't. And most people, when they fix, let's say you've got a $500,000 loan, most people would fix a percentage. They might fix 400 of that and leave 100,000 variable, so you can have all the flexibility to make additional repayments and things like that. But some people think if you fix a portion of your loan, you're saving the risk. You're actually not, because you've still got exit fees if you leave.
Okay, so just based on that, and maybe you can draw this for the people watching while I talk about it. Ordinarily, if you had a fixed loan of 500,000, you can't, and this is ordinarily, you can't pay down extra or exit that without the break fee, which is the baked-in interest.
That's right. And there's some nuances in different banks that have the ability to make a certain amount extra.
An extra $10,000 a year.
Or some have some, but if you're going broad, yes, you'd say that is a fixed loan. You can't pay too much extra and you're not going to have the flexibility of offset.
Yep. So then what you're saying is, if we set up a mortgage that was $500,000 total debt, 400 fixed, 100 variable, the question is, do you think over the next 5 years you can pay an extra $100,000 or more into paying down your loan sooner?
Yep.
And you probably have an offset account against that.
That's right.
If the answer is, I reckon the most we'd be able to do would be $10,000 over the next a year for the next 5 years, awesome. 100 grand, you've got plenty of room, so you can effectively pay down your mortgage sooner for that $100,000 split.
That's right. And for a lot of first home buyers, they use the variable split as their bite-sized chunk that they're focusing on paying off.
Yeah, yeah. And I'll ask another question about this when we talk about parental guarantees. But, I've said before on the show that my first home, it was scary, it was new, it was a $520,000 mortgage. Oh, my gosh.
Yeah.
That was scary, and it was new for me. So I did a portion that was fixed and a portion, it was pretty much that loan setup.
Yeah.
And this is why it's like, as time goes on, you get used to it. I look back at hindsight, why the hell did I do that? It was cheap anyway. But you can't hindsight your own fears and because you're living in something for the first time. You're never not doing something for the first time. And that's okay.
That's right. And I may have a bias. Sometimes I have a bias towards variable rates. And I do that because I've seen people get caught.
The regret.
I've seen this where people come and they're getting divorced and they didn't plan to sell. And now they're getting $5,000 break fee on top of a really tough time.
Yeah.
Or they're upsizing their home, which should be a really happy time, and there's a fixed fee, and they didn't know when they fixed for 3 or 5 years that was there.
Yeah.
So I think as long as you go in with your eyes wide open and you know exactly what you're signing, you know what the risk is, fixed are great. But I probably see people on the other side a little bit too much. So I definitely have a bias to variable.
But that's the behavioural thing. Like me paying principal and interest on investment properties, most people would go, you're an idiot.
Yeah.
But I know, no, I spend money. It is forced savings. And it's like the analogy, of literally going through this ankle stuff at the moment. I was talking to the surgeon yesterday. I'm like, well, if you cut, will you put a moon boot on me for 2 weeks? And then he said, well, generally when you get the surgery like that, we put the back slab on for 2 weeks so the wound can heal.
Yeah.
Now, but he said in your situation, your skin's good. I wouldn't put a back slab on for the first 2 weeks because he needs to keep the ankle moving. But it's almost like surgeons will put the back slab on knowing that, the stitches will hold, but we're doing this as a behavioural thing so we can make sure you don't get in your own way and want to move and break the stitches.
Yeah, absolutely.
Dumb analogy. Whoa. I talked about January. There's no magical thing that happens in January in bankland. But are there any new lending opportunities that you are seeing out there in the trenches in more of a, for example, if we went to the mortgage brokers conference tomorrow, what's all the brokers talking about at the bar or at the conference table? And you can be as vague as you want, or is there anything?
There's always something, and it's a very dynamic market that we live in, and across 40
dynamic. So
it is so across 40 banks and lenders, they all have. The conference would be a lot more excited to talk about this, but there's a lot of things that change, and policies change, but appetite and risk changes.
Right.
So when a bank is looking for a certain type of business, and it might be a bank's looking for investor business, or they might be looking for low LVR home loans, they will make some changes. They'll pull levers to attract that business. So are there banks at the moment attracting certain type of business? Yes, there are. And they will do that by changing policies. So, if you're an investor that had, 3 or 4 properties and you got told late last year that you were definitely tapped out for borrowing, I would definitely check back in with your broker to see if that's still the case. If you were self-employed, the policies change regularly and banks change a lot. And if you were looking at, repricing your loan and there's a bank looking for, I guess.
I'll get you to say what repricing means.
Sorry, if you were looking at renegotiating your rate and you're looking for a really sharp rate, that's really important to you. You've got a home loan, you've got more equity than before. What's the sharpest rate in the market? You will find it with your broker will know the bank that's looking for that kind of business and they will price it there.
I'm laughing because it reminded me of something yesterday because of this repricing thing.
Yeah.
Because I think ordinarily we see online when people are like, refinance your home loan. It's not always needed.
Don't refinance your home loan.
To get a better rate, you can go back to your lender, ask for a rate review, and that's called repricing. Is that
yes. Yeah.
So yesterday, I got an email from my bank or lender.
Yes.
My bank or lender. And it says, hey, Glenn, we have reduced. I told Ryan, I'm like, what? The bank's just reduced my interest rates? What the heck? And I sent the screenshot to my broker, Tim, from Next Move Home Loans. The only reason I don't use Rach and her team is I don't want the Sphere Home Loan office knowing all my personal information. That's the only reason why I don't use Sphere Home Loans. But I use Tim from Next Move Home Loans, and I've sent listeners there. Tim's a great guy.
He is a great guy.
And I sent him the screenshot, and I said, was this you, Mortgage Daddy? And he's like, which property was that? I'm like, I don't know.
It would have been him.
This is the thing. He said, I don't think we've done anything recently. It looks like it was from August last year, and that would have been us. And I'm like, weird, I just got it now. He goes, it's weird, I'll dig deeper. Seems like old news. He sent it to the BDM, was like, what the hell's going on here? And then last night, he said, yeah, the BDM said it's a stuff up and it shouldn't have been sent. And then, so basically what was Bank West had an email system conniption and randomly resent emails of rate reductions. And I said, I'm like, tell them I want 3 months of no mortgage repayments.
Oh, gosh.
They probably would, but I just put it on the loan. Anyway, so I got an email this morning. Dear Mr. James, we apologise if you received a duplicate email. So there you go. Anyway, so I said to, I'm like, thanks, Mortgage Daddy. And he said, I'll be doing a rate review on all your loans tomorrow.
Oh, I love that. And we do reviews annually, but January.
I just wanted to say Mortgage Daddy live on the podcast.
I know that you did want to say that. But I think we have a team that work over the Christmas break, and they, there's not a lot of conveyances open. So the team that don't want to take leave did a whole lot of repricing over the break, and it was really good. Some of the banks just we got more of a discount than we were getting earlier in the month, and that will change all the time. But my bugbear is where people think they have to refinance. I don't like it. The refinance is not the solution. If you want to get more money out, if you want to buy an investment property, if you're doing some changes structurally, absolutely it's a refinance.
Because I think the thing here, and we hadn't planned to talk about it, but it's good that it's come up. Refinancing usually means placing the business with another lender. Yes or no?
It can be an internal refinance, but yes,
sure.
Generally yes.
But the fact is, if you refinance, that's going to, and I'm generally asking because I don't know the answer.
Yeah.
Would that trigger a full application and a credit check?
It would.
Yeah. But a repricing wouldn't.
So I'll give you an example. So a safeguard that I have in place in my business is if somebody's doing a dollar for dollar refinance, which means someone's got a loan for this, they're not increasing their lending, they're just refinancing, you need to come to me with a please explain.
Oh, so your brokers need royal assent from Her Majesty if there is a dollar for dollar refinance in your business.
Yeah, because it would shock me if the current bank wouldn't match the price. And I want to know that everything's been done.
Yeah, and why would you want to put yourself through all this heartache of paperwork and applications and an inquiry on your credit? Not that that's we're leading.
It doesn't
life
really
with that.
matter if you get an inquiry, but why go through the pain and suffering of it? And a lot of people, when they do it, then they just extend out their loan term again and they end up paying a whole lot more interest.
And that's the tip. If you are, quote unquote, refinancing to another lender, my unsolicited advice, and Rach's probably solicited advice, would be if you've got 21 years left on your mortgage, take that to the new lender and sure, rewrite the loan with a new lender, but set the term at 21 years.
That's right, with the exception of, and this is where people get stuck because a lot of the time that people have the intent of taking it out over 21 years, but when it actually gets to the bank's servicing calculator, it doesn't service.
Let them, yeah.
It may not let them do it. So if for some reason...
Just let them.
If for some reason you have to stretch it out...
Did you?
I didn't.
I'm sorry.
If for some reason you've got to stretch it out to 30 years, and that's fine, you can set your repayments to the 21 years so you're not losing anything.
Yeah, but no one does, do they?
Oh, they do.
Oh, they do?
Yeah.
Okay.
So people really do set their repayments, especially when they're buying investment property. So you might need to stretch. You might have 10 years left on your mortgage, and then to buy an investment property, you've got to stretch your mortgage out to 30 years again. And when you explain that to someone, it's really hard because like, no, I'm not paying my mortgage. You don't want them to either, but you just set the repayments up when the mortgage documents come up and it says, what repayments do you want to do? We actually set it there to be 10 years. And you can do whatever you like, but you're not contractually obligated then to pay it over 10 years. So that's about your psychology of where you think you'll call the bank and change it.
Yeah. So if you think that you want to get a better rate, go back to your mortgage mummy or daddy.
Yes, and get them to reprice it. You know, the retentions teams of the banks are working so hard to keep business. It's a lot cheaper to keep existing business than to go and get new business. So in my experience, they're matching what we're putting in front of them. We're doing a lot of reprices and nearly no dollar-for-dollar refinances.
Well, there you go. And I'm probably regretting mentioning Tim from Next Move Home Loans because his email inbox might blow up. That's why we fear support the show, because Rach has multiple brokers and capacity.
Yeah.
Where Tim doesn't have 15 brokers working for him.
But he's very good.
He's very good. But go to Sphere or Tim, whatever, don't care. We'll take a break. And when we come back, I want to talk about something, parental guarantees. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
Rightio, one thing that is, I don't know, parental guarantees. I believe if there's willing and able parents with equity, it's actually such a low-risk strategy. Have there been any changes or big changes in the lending landscape with parental guarantees?
I would say there's a lot of parental guarantees happening.
But the fundamentals haven't changed.
They haven't changed. I mean, if you look over
I tried to give my friend a guarantee to buy their first home. No bank would do it because I'm not. So I'm talking about, has there been any landmark changes?
Not landmark changes. It's called family equity, so you should be related to be able to do it.
They need to change that because why not help first homeowners? Like, I've got equity. Why can't I help a fellow person or Aussie or whatever that's a friend who I've known for a million years? Why couldn't they use my equity?
It has to be family because there is a risk to the person putting up the guarantee. And I guess for parents or for siblings, they can see that, or even aunts or uncles, they can see that benefit. It's helping your family. But I guess they've got to show the benefit for you if you're just doing it for a friend.
Well, the benefit for me is no benefit. I just want to help friends.
That is very kind. But they are happening a lot more. And I'm going to get on my soapbox for a minute and talk about, can I just get on my soapbox and say something I think is going to be a potential problem. So a lot of people, and we're doing, I would say, dozens of these a week, which is the Australian Government 5% Guarantee Scheme, which is where people have the 5% deposit and the government guarantees the 15%. So a lot of people are not using a parental guarantee that would have used one because the government's there saying, I'll guarantee you. And that's great.
Is there a but coming?
There is a but coming. The but coming is there's two things they're doing that I think I'm going to earmark some problems that I'm going to see in the next year or two, which is if you're a first home buyer buying your first home, there's two things that you do to mitigate risk. One of them is you leave out a really good buffer. So a lot of people are leaving out good buffers to say, I'm going to leave my emergency fund in an account, so if anything happens, I've still got that money there. Well, with those loans, and they're still great loans, you've just got to realise how to navigate them, there's only a certain amount of funds you can leave out. And that changes between banks. But let's say it's $10,000 for one particular lender. Well, that's all you can leave out. So if something goes wrong and one of you were to lose a job or something like that, you may not have a big enough emergency fund to be able to get through the storm. Now, what happens when people do get to that position, and the last 20 years it's been really common, one of you lose your job, things get a little hard mortgage-wise, what do? You move home with mum and dad and you rent the house out to try to get through. Well, with the 5% guarantee scheme, you cannot rent that property out at any point that the guarantee is in place. So if you did get into trouble and needed to...
in practice, people probably would.
You can't. In the climate that it is today, everything is known. If somebody rents that property out, let me tell you.
You reckon it's mapped to like the ATO or something?
It's everything. Everything they know. So I've had a client that legitimately rented a room out and they got to please explain.
But I bet many people do and they shouldn't. But there's probably like a ATO audit trail. You just wouldn't do it, would you?
You wouldn't do it. And I think in the current climate, it would be very easy to tell if that property was rented out. So I think you really need to release that guarantee of the government before you rent the property out. So those are the two things that could be a problem. And when it gets explained to people, some people are still going, I'm going to use a parental guarantee rather than that because actually I might want to rent that property out. Or a lot of people are buying their first property as an investment. And I guess that's obviously not...
Well, you couldn't use the government.
You can't use the government, and then it's a parental guarantee. So there is a lot of parental guarantees happening.
So is the hierarchy in terms of assistance, if the parents are willing, able and there, go there first before the government deposit scheme?
I think the government deposit scheme suits people who are really comfortable with their repayments, are really comfortable with the fact they're going to be living in that property long term. But yeah, I definitely still explore both options.
Yeah, and I will disclose, just for complete transparency, at the time of this recording, I am one of the spokespeople for this government scheme.
Yes.
So, and I'm a big believer in it, and I wouldn't have agreed to do it if I didn't think it was good. But I think more people are getting into homes sooner. But I think when you are going to your lender to buy a first home or investment property, well, a couple of things. If you are going to buy an investment property as your first home, well, the government schemes aren't on the table anyway.
That's right.
But for the maximum flexibility, I'm thinking if a parental guarantee is available, maybe that's the first port of call.
I think if you were buying and the intent was to ever rent it out, and, if you thought, well, I'm going to rent that out in 2 years' time, I would still be looking at other options.
Yeah.
And I'd also try to keep as much funds out as you are allowed to, because you still want to have an emergency fund, and some lenders will allow you to leave out more than others.
Yeah. Cool. Any other soapboxiness?
That's on my whole soapbox about the guarantee.
So basically, when it comes to parental guarantee, if you just dab on the right, what type of overarching things and risks and exit pathways do we need to look at the start, knowing that to release the parental guarantee, two things probably have to happen. The property increases in value, or you pay down the release.
That's right.
Or both.
That's right.
But both of them mean LVR overall has to be reduced.
That is right. So we talked about equity earlier. So that equity position, you might borrow at 100% using a parental guarantee. The property might go up 10% in value and you may pay 10% off of the loan, and then your LVR is 80%, and that's when you get the parents released, or the government release. So it works the same. So releasing the government from your guarantee when they do that is exactly the same as releasing your parents. You need to have sufficient equity to do it. So when we talk about a parental guarantee, generally the property goes up in value faster than you can pay it down. And if I look, we've had a really good market. So the last, I would say, 7 years, those guarantees are getting released very quickly because the property market has really steadily moved up. So there's parental guarantees we've done last year that are already released.
But you can't go in with the
You
intention
cannot,
of-
and that's the thing. I really am clear that people say, oh, I did one for my son and it was released in 12 months and we're doing another one. I would still prepare the parents that this could be a much longer term thing because we don't know that property prices are going to move in the same trajectory as they have. So people have to be prepared for a longer term strategy, like with the government one. So people are going into that government guarantee scheme thinking, oh, I'll get the government off in a year. Well, you don't know that. It could be 5 years and they're still attached. So just make sure that you're thinking about that before you go in.
And I will say, as much as I'm a fan and I think it is a low-risk strategy for the parental guarantee, it could be available and the parents could be willing, but it might not be a fit. And you might go, what do you mean by that, Glenn? Well, when I bought my first property, my parents were willing and able to use a parental guarantee. But I took the view that at the time I was busy building business, I knew that they were wanting to sell and move. And while you can transfer a guarantee by moving properties, I took the view that this is going to be so much easier and quicker for me over the next couple of years to just pay, I think I paid $14,000 of LMI for my first home, even though I could have not paid that and got a parental guarantee. Because for me, I just didn't have the emotional, mental capacity to take mum and dad on a journey, explain to them and sign this, sign that. Okay, then when you sell the house, because I knew that they were wanting to sell and move within the next couple of years, I'm like, it's just going to be easier for me just to pay the $15,000. It's capitalized onto the loan and get on with my life.
Yeah, but I think
and people will go, you're an idiot, Glenn. And I'm like, yeah, that's not the first time I've been called an idiot, but we'll compare our net worth and we'll see who made the wrong decision. And it probably wasn't the wrong decision because I've done quite well in life by doing that. So
I bought my first investment property, not my first home, but my first investment property using a parental guarantee. It was only there for a short term. I'm pretty passionate about them. I think they're a great tool, but they're not for everyone. And not everyone has that, I guess, ability. A lot of parents don't own property, and a lot of parents who do aren't willing to do something like a guarantee. But I have this conversation at least once a week. At least once a week, this is a conversation that happens. Somebody says to one of the team that they're going to go on a savings plan for 18 months, 2 years, or whatever it is. The parental guarantee isn't available. And when asked why the parental guarantee isn't available, they said, just not something that I want to ask. And then a conversation with those parents happen, and those parents want to do the guarantee. It happens all the time. When they understand how it works, they want to do it. Now, it's not there for everyone. It's certainly not for people who don't have great habits and don't have great savings and all of those sorts of things. I wouldn't be even talking to a parent that had somebody who I guess had a lot of personal debt and things like that. But I'm talking about something else. I'm talking about the people who I've got all my personal debt, I've got my emergency fund, I'm about to start embarking on this 2-year journey to save a deposit. Some parents don't know that they can take that 2-year pain away. Yeah.
And that's the thing. I do know that there could be parents that own their house outright. And because you can do a parental guarantee if there is still a mortgage, provided, rewind, usable equity.
Yeah.
There are still parents, and I know because I was trying to help someone last year, I knew the situation intimately. I knew that the parents' house had lots and lots of equity. I knew that the parents were probably going to leave that house feet first in a box, not going away. I knew that the child would pay, would do all that, but there was just something in the parents, even once they understood everything, they didn't want to take that risk, even though they fully understand. And that just goes back to risk profile. And some people are just so conservative. We had, I wanted to do a What Would Glenn Do on the Retire Right podcast, and where someone interviewed them, I said, I can do it audio only. I can change your name to Barbara, not your real name. All good. She wrote back, I don't want to do this in case the ATO ping me, Centrelink attract, and I was like, I don't live on any type of planet where if you come onto a podcast with a different name, and talk first name only your situation that the ATO and Centrelink are tracking you down. I don't live on that planet. This woman did. So there are situations where there might be a risk profile from parents, even though it's a limited guarantee, that they will not do this in a million years. And I'll just throw to you in finishing on the PG section, talk to us about limited and full guarantee.
Yeah, so you'd only ever do a limited guarantee, and most banks only do limited guarantees now. It's very different to how it was, but it's a limited amount. So let's say it's you're buying for $500,000 and you've got no deposit. It might be 20% of a guarantee, and that's the limited amount that the parents are guaranteeing. But not saying it's for everyone. I'm just saying if you want to go on that journey of what options are available to you, tick that off before you move on. Is it available, yes or no? If it's not, great, move on to the next strategy.
Yeah. And we had this discussion when we finished writing the manuscript for the Quick Start Guide to Your First Property, and we spent a bit of time on parental guarantees. And this is where it's the art versus science of the broker, and it's the risk profile of the person. It's all that. I'm like, let's draw a diagram of how parental guarantees work. I drew it. You're like, no, don't do it that way because in practice it works this way. I'm talking about setting up a separate split that just represents the parental guarantee portion.
Yeah.
So if people just want to put that portion secured against the parent's home into a separate mortgage split, they can do that.
Yeah.
Or you can throw it in there's so many options. And I guess I say that to say that part of the discussions with the parents would be, hey, if it makes you more comfortable, we set up a split for the kids that is just your equity and their reason for living is to pay that down to zero as soon as possible.
Yeah.
I don't know, there's just so many options.
So if anyone's parents are wanting to know about that, I'm happy to have a chat.
Yeah. And you'll have to read the book to see what diagram we ended up using because I actually don't remember.
It's not as simplistic as you would have loved, but it is accurate.
Yeah. Oh, gosh. Can't win. All right. I'll get you to tap there. Self-employed people. Talk to us about some of the flexibility or anything to do with self-employed.
Self-employed is where I've seen the most change in the last few months, and it is fantastic for self-employed people. There are a lot of different banks that have a lot of different policies, and they're all major banks and they're all great rates. So the days of low doc lending is gone. It is not higher rates because you're self-employed. It is working out a strategy of what suits best. So whether it's 1 year's tax returns or whether it's a payslip policy, and I say payslip policy, I'm a company director. I have a company set of financials. I also have a family trust that the company flows down to my family trust, and then I have a set of financials for that. And then as an employee of Sphere Home Loans, I get a salary. And if I was going to borrow money today, I could just give my payslip.
Which is so outrageous.
Wild. I could give my payslip as the employee of Sphere, as long as I'm paying myself correctly all through the single touch payroll system. They're paying tax on it, which is really what people want to see.
Yeah.
I can leave my company returns and my trust returns out. And you and I both know they can be complex, and we have different strategies in there. And if you can just do the payslip rule, it is amazing.
Yeah. And it's so funny. You really, and I think it has changed because I remember years ago when I was preparing to get a loan, and obviously correct me if I'm wrong, we had to do the financials in my business because I had a trust structure that I was the operating entity where I had to effectively pay more tax to bump the figure on paper to get the mortgage. Is that?
Well, yeah, that's pretty much it. Do you know what?
I mean, gosh, I don't want to go down this rabbit hole, but it was effectively if you're a sole trader or a trust, you are not you don't have to be an employee. You can just take distributions from the trust. And as a sole trader, you're not an employee because you're a sole trader.
Yeah.
The question is, and it may have been the way that the financials were in my business, I don't remember the details, with the broker at the time and the business at the time, it may have actually been faster and easier to get a house to PAYG my income, pay a little bit more tax, get the servicing up, rather than relying on financials that might not have been good. It just speaks to you need a confident broker in your corner to work out the best strategy if you're self-employed.
And a lot of the time it's working alongside your accountant. So we
Yes.
do a lot of meetings with the accountants in preparation for the next move. But if you're self-employed and someone's saying for you to do a low doc loan, stop.
Yeah, so low doc is documentation.
Yeah, low doc loans are traditional loans for self-employed people. You sign a piece of paper saying this is what you earn, but they are loaded rates. They're second-tier lenders. You don't have to be going down that road. Your broker might need to get a little bit more strategic in looking at all of the information available and picking what's the most fortuitous for you. And yes, you might need to pay some tax.
So any key kind of takeaways for self-employed, I don't know, I'll put words in your mouth, but I'll say don't assume you can't get a mortgage if you're self-employed.
That's right. And I actually just had Joe on the property show earlier this morning, on This Is Property this morning, and he shared an example, which I didn't know about until he shared it, so I'll tell you about that. It was he shared a story of a physiotherapist who was working for somebody else, and that was they were a PAYG employee 6 months ago. So they were employed by a physiotherapist. A clinic?
Yeah.
6 months ago. And then they've decided, I'm going to start a business. So
Practice.
A practice.
That's the word.
So they've started their own business from scratch 6 months ago. They've got no tax returns. They've been self-employed for 6 months. Now, traditionally, and even if you asked me 2 hours ago, I would have thought, that's probably not ideal. He was just saying that he got it approved on the basis that they could go back to their old job and it's serviced on their old income.
Yeah, so what's the problem here?
So what's the problem? So
Yeah.
it was a this makes sense credit manager.
Yeah.
Let's do it for this client. And so I would say the hard and fast rules are not as hard and fast as they were last year.
On the I just want to swing back to the parental guarantee I was going to talk about. There are other options if putting the parent's home at risk, even limited. Because remember you did this loan for me when at the time I was after an investment property. There's some stuff going on with mummy and daddy, good stuff. And we actually used a parental guarantee, but we didn't use a property.
We use a term deposit.
Yeah, so talk to us about that.
So sometimes you can use a term deposit for the guarantee, and there's been an example recently where somebody because sometimes the parents downsize while the guarantee is still attached. So it goes against their house, the parent's house, and let's say they're going to buy a unit, you can pick up the guarantee and move it to the other property. But in one case recently, the clients weren't going to be buying straight away. They were going to sell their house here, travel Europe for 6 months, and then come back and buy another property to live in. Well, the guarantee went from the house to a term deposit to their new property. And look, that's complex. And, if I was having a lot of changes coming as the parents, the guarantee might not be right for you. But if you wanted to do it and you were going to do some moves, you'd want to make sure the broker put it with a lender that was going to suit what you were going to do. And that changes.
And the key difference here, and we'll just say if there was $100,000 security, that term deposit would be at that bank that the mortgage is with for the child. It's a locked term deposit, call it 1 year. It's in the parents' solo, both dual name.
Yep.
They can still receive the interest.
That's right.
And then the term, at the end of the first year, they say, do you want to roll this over for another 2 years or 1 year? And it automatically rolls over.
Well, they can't touch the principal of that term deposit until the guarantee is dealt with.
No, that's right. But I'm just thinking if the guarantee was over 5 years and it was a 1 year term deposit,
they just have to keep rolling it over.
It would have to keep rolling over.
Yeah. They couldn't cash that in until the guarantee moves somewhere else.
Now, could it sit in a bank account that's locked and not a term deposit?
In my experience, I've only ever seen term deposits. Not to say it's not possible somewhere, but I've never seen it done other than a term deposit.
And the reason you use term deposit because it's generally a higher rate than the floating interest rate. So, okay, we'll wrap it up there. Any final comments that you think are really relevant for people to understand if they have a mortgage or if they want a mortgage this year?
If they want a mortgage this year, I would say a big thing is looking at, I guess if you've got a mortgage and you've got other stuff that's at high interest, don't have that. Like if you've got, so I see this really as a really common thing now, that somebody's got a mortgage and they've got $10,000 in available redraw and then they're paying 18% on credit card debt that's at 5%. Move that around.
Yeah.
It makes you feel like you've got a $10,000 redraw available to you, but don't pay interest on other things.
Yeah.
So your home loan's generally the lowest rate that you've got. So get rid of all of that personal debt if you've got that available on redraw, and just make sure that you're not paying interest on other things that you shouldn't be paying.
Yeah.
It just doesn't make sense. The other one might be, if you've got equity in your property that you didn't have before or it's gone up in value, get a review.
And if you don't have a property, home to live in as a first home, an investment property as a first investment property, or you own a home and you want an investment property, or you've come out of a separation and you want to start again, all these things, I would say to you, most people, most of the time, when they speak to a good mortgage broker, will get into a home faster than what they thought in their mind.
100%. So I think the best thing, if you're thinking about getting into the property market and it's a goal for you, even if you're on a 12-month savings plan and you're right at the beginning of it, it is worth having a 15-minute chat with a mortgage broker just to say, am I on track? Are there any other things available to me? And tell me, am I doing the right things? Now, I'm just going to flag a big thing about help debt that I completely forgot to mention.
Also proud of you for using the word help.
Yes. Isn't it HEX in a certain state still?
No, it's federal. We had this discussion when writing this book. I'm like, I'm finding and replacing everything that says HEX.
I say HEX all the time.
HECS, find and replace with HELP.
Oh.
There is no such thing as HEX debt. It's called help debt now. Anyway, proceed.
If you have a help debt and you're considering paying that off before getting your mortgage, go and talk to a broker before you pay it off.
And a car loan.
And a car loan. So the help debt, there are cases where you can borrow more if you have a help debt than if you don't have a help debt. So you actually could be shooting yourself in the foot by paying it off before you get a loan.
Didn't some lender change it so they don't actually see the help debt at all, not putting it into
there's a couple of different policies, but one of them is if you've got a small help debt, you can actually borrow more than if you have no help debt. Policies don't always make sense, but
that's just probably unintended consequences.
You don't want to shoot yourself in the foot. So things like if you're thinking, I'm going to pay off this car loan, then I'm going to pay off my help debt, then I'm going to save for a deposit. Just have a chat with a broker and really get a plan in place and understand how all of those things work.
Love it. Rach Kroon, thank you so much for giving us an update. You've heard Rach here on the show before. She's the founder and director of Sphere Home Loans. She also hosts the show This Is Property with John Pidgeon. I would like to call Rach a friend of mine as well.
Aww.
And most importantly, my mortgage mummy. Now, thank you everyone for your patience and grace this year while we continue to work on this studio with the microphones and the YouTube stuff. If you found this episode useful, just let us know in the comments if you would like, and you can do this on Spotify or YouTube. One thing I actually didn't do, I think we need to just book in every 3 months, because this has been great, a mortgage broker update where we just do an episode with you on everything that we've talked about. Because the reason I haven't before, because I'm always talking with Rachel, was like, no, let's do a deep dive on what's happening lay the land.
Right. We used to do it before I became
That's
a host,
right, but
and
now that
we've
you're
stopped.
everywhere, I see you all the time, but it's like, all right, we'll come in and do a mortgage broking thing. So thank you so much for everyone for listening and watching. We really appreciate your support, and thanks, Rach Kroon. We'll see you soon. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.